Thank you for joining me today. My name is Cynthia Asen. I'm a dealing representative with Parvis. I have prepared a short formal presentation and it will be followed by a Q&A. You may participate by raising your hand and one of us will unmute your mic, or you may enter your question in the chat. We'll definitely get these answers by the end of the session. So this presentation is about investing in real estate using registered accounts, RSPs, TFSAs. The presentation will explore how investors can use funds to access private real estate or private equity opportunities. We will focus on institutional style strategies and real estate, investment grade real estate. Real estate plays a critical role in long-term wealth preservation, income generation, and inflation protection. Our goal is to show you how these opportunities can be accessed efficiently within registered plans. As with all investments, this presentation will contain information, has forward-looking information based on current expectations, assumptions, and market conditions. Actual results may differ due to changes in economic, regulatory, or real estate market dynamics. Projections and target returns are not guarantees and should not be relied upon as predictions of future performance. Everyone should review offering documents carefully and consult professional advisors. We always are open and transparent to the information and encourage people to seek to understand before making any investment to ensure suitability. Who are we and what do we do? We work with investors seeking exposure beyond traditional stocks and bonds. Our role is to introduce private market opportunities that complement existing portfolios. These strategies are designed to address income, growth, and diversification objectives. Our focus has been real estate, but we also offer some alternatives to that within the private equity structures. We want to align with long-term capital appreciation and investment. Access, due diligence, and structure are central to what we do. We're dealing representatives with Parvis, which is an exempt market dealer, and we're licensed under the Canadian securities regulations. Public markets matter, but over-reliance on them introduces concentration risk. Alternative assets behave differently across market cycles, providing balance when volatility rises. Diversification helps smooth returns and reduce portfolio drawdowns over time. It also introduces new sources of income and growth not correlated to equity markets for high net worth investors. Real estate has long been a cornerstone of alternative investing in Canada. It offers tangible assets, contractual cash flow, and inflation sensitivity. Investors can gain exposure across multiple segments, including residential, commercial, industrial, development, and lending. Each segment plays a distinct role in a portfolio. Together, they create a diversified real estate allocation. Parvis provides access to a curated marketplace of real estate investments. You're not limited to single manager strategy. Instead, you can select opportunities aligned with your income needs, growth objectives, or both. This flexibility allows for intentional portfolio construction. It mirrors how institutional investors allocate capital. All investments offered are structured to meet CRA eligibility requirements. Assets are held to approved custodians rather than direct ownership. This allows investors to benefit from tax-deferred or tax-free growth. Each structure must comply with plan-specific rules and limitations. Proper structuring is essential to preserve the registered status. The most common financial structures in private real estate investments can take several legal and financial forms. These include limited partnerships, mutual fund trusts, mortgage investment corporations, and real estate investment trusts. Each structure carries different risk, liquidity, and return characteristics. Understanding structure is just as important as understanding the asset itself. Structure drives the outcome. Experienced management teams are critical in private markets. These groups bring local expertise, operational discipline, and repeatable execution. Track records provide insight into how capital is deployed across cycles. Clear investment strategies reduce uncertainty and enhance accountability. Investors are aligning with operators, not just assets. We have several strategies that are deployed within our investments. Fixed income emphasizes capital preservation and predictable cash flow. Core Plus strategies focus on stabilized assets with modest enhancement potential. Value add targets operational or capital improvements to unlock value. Opportunistic strategies pursue higher returns through development or complex execution. Each strategy serves a different role within the portfolio. Return targets across the platform range broadly depending on strategy and risk. Lower risk strategies emphasize income and capital stability. Higher risk strategies pursue enhanced returns through execution and market timing. These strategies are projections, not guarantees. Risk-adjusted return expectations must always guide allocation decisions. The platform aligns opportunities with investor-specific objectives. It provides access across the risk-return spectrum in one place. Investors compare offerings efficiently and transparently. This reduces friction while improving decision-making. The result is better portfolio construction. Over the years of working with investors, there are some very common questions, and primarily they focus on how returns are generated, what liquidity and access to capital are during the investment. These are critical considerations. Risk assessment is equally important as upside potential. These questions guide every investment decision. We address them transparently for each investment structure. So let's look at the mortgage investment corporations that we offer. This is just a sampling. We have, I believe, 10 on our shelf. Mortgage Investment Corporation focus on real estate secured lending. They're designed to generate steady income rather than capital appreciation. These investments appeal to investors seeking yield with lower volatility. Capital is deployed across a diversified mortgage portfolio. Excuse me. This strategy, This strategy is often used as a fixed income alternative. A mortgage investment corporation pools investor capital to originate and hold mortgages. It does not own or operate real estate assets. Income is generated from interest payments made by borrowers. This structure emphasizes lending discipline and risk management. Returns are linked to credit quality rather than property values. Returns are primarily from interest income on mortgages. Borrowers pay interest, which flows through to investors after expenses. Portfolio diversification helps manage borrower level risk. Performance is driven by underwriting quality and loan structure. Market speculation plays a limited role. Mortgage Investment Corporation investments are designed for longer-term capital, although they are some of the most liquid options we provide. Redemption penalties may apply for early exit. Investors should align allocations with their liquidity needs. The biggest risk is borrower default, and that is a key consideration. Real estate market conditions can affect collateral values. Interest rate changes may influence borrower behavior. Risk must be weighed against income stability. Real estate investment trusts own and operate income-producing real estate assets. They provide exposure without direct property management. Investors participate through unit ownership. The Core Plus strategy balances income with moderate growth. This structure appeals to long-term investors. A real estate investment trust is a trust or company that holds real estate assets. Income is generated through rents and operations. Investors benefit from professional management and scale. REITs offer diversified property exposure. They simplify real estate ownership. Returns are driven by rental income and operational efficiency. Property appreciation contributes to long-term value. Financing structure influences cash flow. Performance reflects asset quality and management execution. Returns are tied to real estate fundamentals. Private REITs are not publicly traded. Redemption features are limited and conditional. Liquidity depends on portfolio cash flow and trust policies. Investors should expect multi-year capital access is structured, not immediate. Market and valuation risk impact asset values. Interest rates affect financing costs. Tenant performance influences income stability. Liquidity constraints require long-term planning. Many real estate investment trusts have established credit lines for liquidity purposes. Mutual fund trusts pool capital into diversified real estate strategies. They often pursue value-add objectives. Active management seeks to enhance performance. These structures offer professional oversight. Risk and return sit between core and opportunistic strategies. As you can see, it ranges anywhere from, they're usually the mid-teens is the returns that we look for in the mutual fund trust. This structure allows investors to own units in a pooled vehicle. Capital is managed according to a defined mandate, usually a trust agreement. Real estate exposure may include direct assets or investment into real estate investment trusts. Investors benefit from scale and diversification. Management execution drives the outcome. Returns are generated through income and asset appreciation. Operational improvements enhance value. Market timing plays a limited role. Performance reflects management skill. Long-term value creation is the objective. Again, these are private. They do not trade publicly. Redemption options are limited and conditional, but they are available. Capital is typically committed for several years. Liquidity planning is essential. Investors must align expectations accordingly. All of this information is contained in the offering documents, and easily to understand prior to making any investment. Market risk impacts valuations. Financing costs influence returns. Operational execution affects outcomes, and liquidity remains constrained but is available. Risk varies by strategy and manager. Managers will provide business plan, which includes market-related fundamentals and economic sensitivities. Limited partnerships are commonly used for opportunistic strategies. These strategies are generally not available for the registered account. However, I wanted to cover them in this presentation. Investors provide capital while the general partner manages the execution. These structures target higher returns. They involve greater complexity, and discipline and experience are critical. General partners control the operations and decision-making. Limited partners contribute capital with limited liability. Investors participate passively. Returns really depend on the execution quality, and they come from development, repositioning, or sale. Cash flow may be available, but generally is not, and may be intermittent. Refinancing events can return capital. Performance unfolds over time. Execution drives the outcomes, and investors generally share in the profitability. Limited partnership investments are highly illiquid. Capital is locked in for a defined term. Exits typically occur at sale or refinancing, and interim liquidity is rare. Investors must commit patient capital. Risks are dependent on what the limited partnership structure is, but development and construction risks are material. Financing conditions affect the feasibility, and execution risk rests with the general partner. Again, liquidity is limited, which takes us to our final sort of option: private equity alternatives. Expand diversification beyond real estate. Strategies span the core, value add, opportunistic profiles. Assets are privately held and actively managed. These investments target income and growth, and liquidity is limited by design. These investments sit outside public markets. They are structured privately and often illiquid. The focus is on long-term value creation. Diversification benefits are significant, and really, the structure shapes the outcomes. Returns are driven by business performance and cash flow. Investors may receive distributions or preferred payments. Value creation occurs over time. Market volatility plays a secondary role. Execution is paramount. Capital is committed for multi-year periods. Lockup terms are standard. Redemption windows are structured and limited. Full liquidity typically comes at fund maturity. Operational risk within portfolio companies exists. Market and economic conditions affect performance. Liquidity constraints require patience. Diversification helps manage risk, but it does not eliminate it. As we've shown, private investments are generally illiquid or constrained. Investors do not control daily decisions. Outcomes depend on management execution. Time horizon matters. Risk tolerance must align with the strategy. Making an informed decision based on understanding the business plan and time horizon to ensure suitability is paramount. We do our very best to conduct thorough due diligence to independently verify the information. However, there are no guarantees. This is why it's very important for us to understand your objectives, your risk tolerance, and your current financial position so that we can make suitable recommendations. Investment strategies should reflect your objectives. Portfolio construction is customized to suit what you want as an outcome. They're not standardized. Alternatives are typically capped as a percentage of your total net financial assets so that we don't exceed concentration limits. This reduces your risk. So it's a disciplined approach to deploying your capital. Every investor situation is unique. We do encourage a one-on-one discussion, which allows us to provide a much more tailored analysis and recommendation for you. We review objectives constraints, and opportunities. Your education precedes any allocation decisions. Thoughtful planning leads to much better outcomes. This presentation is for educational purposes only. It provides an overview of what we offer. It does not constitute investment advice. All of the investments we recommend should be reviewed in full detail with you. Suitability is assessed on an individual basis. Thank you for your time and your consideration. Now we will open it up for questions.